I'll just give a little bit of an overview, start off with who Diamond Mortgage is, what we are, where we are located, and how the general process, the loan process works with us. First off, we are nationwide. We have locations in 15 different states, so we're not just a local lender. We have 5 offices in Indiana alone, 1 in Valpo, which is where I work. We have 1 in Portage, Schererville. We have 1 out in Fort Wayne, and we have 1 down in Indianapolis. So again, our headquarters is in Lake Forest, which is on the north side of Chicago, and we have locations in 15 different states. Next topic I'll talk about is a mortgage banker versus a mortgage broker. Not a lot of people know the difference. The simple version is a mortgage banker is an all-in-one, and a mortgage broker needs a banker. A mortgage banker is what I am. I can help originate. I can help walk your client through the entire process, and then Diamond will fund the loan. Mortgage broker will help your client through the process and then find a mortgage banker to supply the funding for the loan. So the main difference as far as your client goes is mortgage broker tends to be more expensive because they're a middleman. Next big topic, which kind of goes along with the banker and broker, is how a lender processes and underwrites the files. We have in-house underwriting and processing. My processors and underwriters are a phone call away. Processors sit in the same building. Maybe not so much right now because everybody's working remote, but when we're under normal circumstances, my processor's 10 feet away from my desk. So the advantage to that is, again, it's a middleman versus an all-in-one package deal. The general loan process takes about 45 days. Right now, it's kind of pushing that limit a little bit with how slammed the market is. And I'll break down what adds up to 45 days here in the next slide. Pre-approval versus pre-qualification. This is such a huge topic. A lot of lenders, especially now when the market is very busy and very, very slammed, a lot of lenders will give pre-approval letters when they really shouldn't. The main difference, if you get a pre-approval letter, the lender is supposed to look at all of the documents, supposed to look at every page of the bank statement from your client, supposed to look at pay stubs, W-2s, IDs, make sure the driver's license isn't expired. You know, all the small items that can cause problems down the road can be avoided if you have a lender that does a very thorough pre-approval. A lot of lenders, and it's really just a mentality. If you're a lender that is focused on quality, then you're going to do all of those steps. If you're a lender that's focused on volume, then you're going to spend as little time as possible on each client so you can talk to as many clients as possible. So what does that mean for you guys? Well, if you're a listing agent, it's huge because you can accept an offer from a client that hasn't been fully pre-approved. So it's worth, as a listing agent, maybe making a phone call to that loan officer that's on your pre-approval letter and really finding out how deeply did they look into this client. Did they just talk to them over the phone and give them a pre-approval letter? Or did they look at the bank statements? Did they look at the pay stubs? Did they look at all of the documents? What we do is we absolutely want to look at everything. We want our pre-approval letters to be as good as gold, essentially. And I mean, I've actually had instances where where listing agents have called and they've taken our offer, which might not have even been as high, because they knew they had confidence in Diamond. So, I mean, it does make a big difference. As far as you guys go, just make sure that even as a buyer's agent, that your client is fully pre-approved, because you don't want to be driving around, spending gas and getting your client's hopes up to find out after you put the offer in that they can't get the home. So really just a quick phone call to a loan officer just to find out how deeply they've looked into the client. Next thing is appraisals. That is the biggest time driver right now, is how long appraisals are taken. Normally it takes, I've always said 7 to 10 days, maybe a little bit longer. Now it's a 2 to 3 week minimum. So keep that in mind as you're accepting offers or as you're putting in offers. You know, we could have probably done a 30-day contract pretty regularly a year ago. Now it's almost impossible. Appraisals alone are taking 21 days. So that gives you 2 or 3 days to get through the inspection period. Underwriting as well. Underwriting's taking a little bit longer. Typically, I've always said 3 to 5 days in underwriting. Now it's more like 7 to 10. And it's the same thing. I mean, we set a record almost every month this year as a company, and we've already broken our annual record, and we still have a month and a half left. So underwriting's taken a little bit longer because everybody's jam-packed busy. But generally speaking, takes about 7 to 10 days to get through underwriting. So go through the process just step by step here. First, if you were to send me a client, like reach out, give them a call, talk to them on the phone, find out what their goal is, find out as much of their personal information as I can, their financial information, check their credit. And this is where really plan the loan structure. If you have a client that isn't just doing a very simple, I'm currently renting and I want to buy my first home. If you have somebody looking to sell a home, they have a lot of equity, so they're going to have a lot of proceeds that they can use. That's where you can really get creative as a loan officer, where I can get creative and looking at how much do we want to put down on the mortgage, how much do we want to use to pay debt off, what loan program do we want to use. So that's typically where the structure planning goes in. After that, take a look at their documents, then they're fully pre-approved. Then I can write a pre-approval letter and your client can put in an offer. After the offer gets accepted, go through the home inspection. One thing that not a lot of people know, we don't require a home inspection. So if you have a client, maybe he's a handyman, a tradesman, and he wants to inspect the home himself and save himself $600, he can do that. It's not recommended. I would still just spend the $500 to get the home inspected, but if your client wants to do that, we can accommodate that. After we get through the home inspection, always wait until after we get through the home inspection and we negotiate repairs before we order the appraisal. And the reason being is we don't want to be negotiating repairs after your client has already spent $450 on the appraisal, because it puts them in a situation where they don't have as much leverage in negotiating. So they've already spent $500, so they're going to be more likely to not ask for what exactly they want. So we always wait until after they come to an agreement with the seller before we order the appraisal. Like I said, it takes about 2 to 3 weeks now. Once the appraisal comes back, then we submit to underwriting. That takes about 7 to 10 days. Then we get the clear to close, and we schedule closing. So generally speaking, that's how we want a file to go. Not everyone is that smooth, but we try our best. Next topic I'll talk about is just the different common loan programs that we have. There's 4 common ones. 2 of the 4 make up about 90% of all loans. And those 2 are conventional and FHA. The other 2 that we have are VA and USDA. And those are a little bit tougher to qualify for. However, if you do have a client that can qualify for them, they're very good because it's 0 down payment. And I'll go over the details here in a little bit. Conventional loan is almost always typically your best financial option. We have as low down payment as 3%, which is as low as it can get other than the 0 down programs. And mortgage insurance falls off after 20% equity, which is huge when you're talking about FHA versus conventional. FHA, the biggest advantage to FHA is credit flexibility. So if you have a client that has questionable credit, or maybe they had a bankruptcy or something in their history, FHA is probably the program for them. They also have very low down payment. It's as low as 3.5%, and they have mortgage insurance as well. And the biggest difference between FHA and conventional when it comes to mortgage insurance is FHA, you typically have mortgage insurance for the entire loan. With conventional, like I said, it drops off after you hit 20% equity. So if you put 5% down, then you pay another 15% down through your payments, that mortgage insurance payment will automatically drop off. Your client doesn't even have to call. And that's huge because depending on the credit score and the loan amount, that mortgage insurance payment isn't a $15 or $20 payment. It's usually, somewhere up around $100 a month. FHA for a $140,000 home is right around $100 a month. Next 2 programs are the VA and USDA programs. They're both 0% down. Biggest difference, obviously, VA, you need to be a veteran. There is no mortgage insurance for VA, which is good. However, there is what's called a funding fee. The way that VA handles it is they don't make you pay a monthly payment, but they will tack on a percentage of your loan amount on the back end of your loan. It's typically about 2.5%. So if you have a client that's buying a $200,000 home, there's going to be close to $10,000 that's going to be added onto their loan. And you essentially pay that through your monthly payment. It's just a little bit of a different way that VA handles it. USDA is a very good program if your client can qualify. And I say if your client can qualify because there's a lot of qualifications that they have to meet. First is geographical eligibility. You can't buy up in Valpo, Chesterton, Portage, Michigan City, even LaPorte. Westville, I think, will work. Certain parts of Westville will work, but typically the further south you go, the more likely you are to be in an area that is acceptable for USDA. And there's a website that you just type in an address and it'll tell you eligible or not eligible. There is mortgage insurance for USDA, but it's typically about half of what FHA is, so it's not too bad. And then the other qualifier is household income. So it varies by county, but typically it's around $82,000, $83,000 a year. If the household makes more than that, then they don't qualify. Even if you have a husband and wife and one of them is not on the loan, but they make 50 grand a year, if that 50,000 puts them over that limit, then they don't qualify, even with one of the spouses not being on the loan, which is unique in that program alone. Do you guys have any questions about the loan process or common loan programs so far? Okay. We'll cover the unique loan programs next. These are down payment assistance, new construction, renovation loans, and manufactured loans. So cover the renovation loan first. This is the common one is an FHA 203K loan. It works for purchases and refinances. The way it works is, let's say you're working with somebody that's looking to purchase. They would essentially purchase like a foreclosure, a house that's in pretty bad shape. They buy it for $50,000 and they get a quote from a licensed contractor for all the repairs to make it livable again. Let's say that's another $50,000. The way it would work is we would essentially give them a mortgage for $100,000. They would pay the contractor essentially through their monthly payment, and then after the home is in living condition, they'd move in. Works with refinances as well. If you or you know somebody that's looking to do an upgrade on the home, but they don't have the money in the bank to pay a contractor, they can do it, essentially finance it through their mortgage that way. And it's the same thing. All we would do is we would take the existing balance on the mortgage plus the repairs equals the new mortgage, and then they make that payment. They pay for that through their monthly payments. Biggest catch to the 203K is it has to be a licensed contractor and the owner cannot do any of the repairs themselves. So again, if you have a tradesman or a handyman that wants to do all the drywall or all the electrical work themselves, they can't do that. And the 203K is not available right now due to COVID, but hopefully, when we go back to normal, whenever that is, that'll be available again. Next most common out of these is the new construction program, and that's getting more and more common as we go, since it's such a seller's market and there's barely any inventory. What's unique to our new construction program is it's a 2 times close program. What that means is we get the borrower qualified, we go through the underwriting process, we close, and at that first closing, that's what allows the builder to start the building process. What's good about that is if you have a client, let's say that they currently own a home and they want to sell their home and move into this new construction home, they can put a small down payment down at the first closing, say 3% or 5% if it's conventional. And then once the home is built and we go to our second closing, they can bring the remainder of their down payment after they sell their home. So they don't have to have 10%, they don't have to have 20% before selling their home. If they have all their money in equity, they can put 3 or 5% down at the first closing. Then as we get 2 months or so away from completion of the home, you can list their home, sell their home. They can take the equity to the second closing and get the 20% if that's what they wanted to do. And as far as our new construction program, we have as many down payment options that are available for purchase we have for new construction as well. We have 0 down VA, we have 3.5 FHA, we have 3% conventional, we have all of them. So it's a very good program. The advantage to the 2 times close is if your client decides they want to upgrade something between the 2 closings, they can do so. And not a lot of other lenders have that flexibility. Not a lot of lenders have the down payment flexibility that we have either. And a good bonus for you guys is, as a realtor, you get paid at the first closing. So you get paid before the home even starts to get built. We do finance manufactured homes, and I just want to clarify the difference between manufactured and modular. Modular is considered stick-built. It's considered a normal home. Manufactured is essentially a mobile home that has been put on a steel structure. So biggest way to, or easiest way to tell the difference if you're at the home showing the home is just take a look underneath the home if you can and see if there's a steel chassis or structure under there, and then it's manufactured. We require a 620 minimum credit score, which is a little bit higher than normal, and needs to have a structural certification as well. So the home needs to pass some certain certifications in order to qualify. And then down payment assistance is another one that we can do. Right now, IHCDA is the biggest, most common program, and that stands for Indiana Housing and Community Development. That program is income limited. It requires a higher credit score. The income is county-based, and IHCDA sets their own interest rates, and it's not a market interest rate. Normally, it's a considerably higher interest rate. So there's a couple catches as well with down payment assistance. Some programs, require you to live there for a certain amount of years, and if you don't, you have to give the gift back. So there's catches to those programs as well. It's not just free money. But we do offer those. We can finance those. Cover credit here real quick. Biggest difference that a lot of clients have a tough time understanding is the difference between their credit score and their credit report. Conventional is a 620 minimum score. Just because you have a 621 score does not mean you automatically qualify. A lot of what is inside of the credit report can determine whether somebody qualifies or not. If you have somebody with a 700 score, but they missed a couple car payments, they might not qualify, even with that 700 score. So that's a big difference, is credit score versus your credit report. Another one is credit websites. A lot of people will call in and say, "Oh, I have a 700 score. I looked in Credit Karma yesterday." Okay, Credit Karma is good to have. I have it, but don't put a lot of faith into the numbers. Just kind of use it to monitor, see if somebody checks your credit. If your score jumps up or drops, to look into it and find out why. Credit counseling. Another credit counseling tip that I have is don't go to the companies that advertise, credit repair. A lot of them will wipe your credit score or wipe your credit report clean. So if I were to pull your credit, it looks like you've never had a credit card or a car loan or anything. And when that happens, we have to do what's called alternative credit, which means we have to assume a 580 score. So a lot of times, no matter if you have a client that has a bankruptcy or foreclosure, whatever negative derogatory events that are out there, a lot of times you can get yourself in a better situation in a shorter amount of time by just taking the right steps and paying certain items off and calling certain creditors yourself. You don't have to go to a credit repair company that'll scrub your credit report. Credit inquiries, that's another topic I get a lot of questions on. A lot of clients don't want me to get them pre-approved, but don't want me to pull their credit because they think that by me pulling their credit, their score is going to tank 100 points. And that's just not true. Where you get into trouble with credit inquiries is if you have a client that's going to lender 1, they get denied, they go to lender 2, denied, 3, denied, and they end up having 7 or 8 inquiries in the last 3 months. That's when it really starts to drag your score down. Having a couple inquiries, that's why my first question to clients when they're concerned about this is, how many times has your credit been pulled in the last year? If it's only been 1 or 2, that third inquiry, you're not even going to notice the difference in your credit score. So just cover some basic program guidelines. Conventional is a minimum of 620. FHA, VA, and USDA are 600. Manufactured is 620, and new construction is 660. So various different points in the 600 range. Um, After COVID hit, a lot of lenders really tightened up their credit requirements. Before COVID, the industry minimum was pretty commonly about 580. Wells Fargo over summer increased their credit score from 580 to 680. I don't know if it's still there, but a lot of major lenders really tightened up their credit requirements. So even at 600, we are still, as Diamond, we're still one of the lowest companies that can go as far as credit scores.
Vince, a question came in, if I could read it to you, from Sonia.
Sure.
Do you have information requirements about down payment assistance for different towns that you can share? Thanks, and nonprofit credit repair companies.
Yeah, as far as nonprofit credit repair companies, I'm not too familiar. Like I said, I don't deal with them much at all. Typically just give your client the advice that I have, and that's free of charge. As far as down payment assistance, so IHCDA is the most common. That's Indiana Housing Community Development. Hammond has their own program called Hammond Homebound. Gary has their own program. Really major cities have their own program. Counties, Lake County has their own program. I can get more information on that, but I don't have it readily available as far as the details go. But I know I have used Hammond Homebound. I have used Indiana Housing. I know that Gary does have their own, and Lake County has their own as well.
Thank you.
Next topic I'll cover real quick is marketing options for realtors. So I actually just got a call this morning from a realtor, a McColly realtor, that said, I've been having trouble selling this townhome, and I was wondering if you can put together a flyer showing how cheap it would be or what the different payment options would be for the home based on the different financing, so I can print them out and send them to all the different apartments, so we can really show people who are currently renting how much of a payment difference it is between renting and owning. Not a lot of people realize, I mean, you guys will as realtors, but not a lot of clients realize that sometimes it's cheaper to own than it is to rent in terms of monthly payments, especially if you have good credit. So I can put together all kinds of different flyers for you guys. If you have an open house coming up, I can set up an open house flyer. It shows photos of the home. It pulls your description off of Ganire. And I mean, it has demographics of the area. If it's somebody moving from out of town, it has school facts. It has all kinds of different community facts in there as well. So it really kind of helps paint a picture as far as what kind of neighborhood you're moving into and what kind of home you're purchasing. Again, loan comparisons. If you have a home and you can accept conventional FHA, VA, you can accept all the different loan programs. I can put together a flyer showing your clients what the different payment would be for each program, and at different down payment percentages as well. Can do the buy versus rent comparison. If you have a client that's currently renting and they're not really sure if they want to buy, at least now they know what the payment difference would be. Different market reports as far as interest rates, historical, forecasted, appreciation forecasts for the area, and this is all county based too. It's not national averages. It's local. It's county based. If you have somebody that wants to buy, you can tell them roughly how much their home would be worth 10 years down the road based on county data. If you have first-time home buyers, can do do's and don'ts of the home buying process. A lot of first-time home buyers don't know anything. You pretty much have to tell them everything every step of the way, and it's a very rewarding process, but it can also be frustrating. So the do's and don'ts: don't go deposit $3,000 in cash in your account. Don't open a new car to celebrate your new home before closing. Just items like that. And all of these flyers can be co-branded. They have all of your information on there, all of my information on there, phone number, email. So all they have to do is see the flyer and they can give us a call. You guys have any questions about that? Okay. Well, that's pretty much all that I have. If you guys do have any questions, you can send me an email, give me a phone call. I can send Nathan all my contact info. And if you guys have any questions going forward, please give me a call, send me an email, send me a text, however you want to reach out. If you have any clients, I'd be happy to help them as well.
Sounds good, Vince. Appreciate it. And we've had several agents shout out kudos in the past couple of months to the documents that you guys are able to provide for open houses and showings, things like that, to put them alongside the quality stuff that we're able to produce from our marketing department. So the more items that you can give the folks as a takeaway, the better it is. The one thing that I will mention to everyone on this call is the beauty and the benefit of what I call, hold on, Vince, you still there?
I think he might have dropped off. Oh, no, Vince is still there. Vince is still there.
Oh, okay. All right. Yeah. John's pointing them out. Sorry, I think Vince was talking to somebody else. The one thing that I wanted to just briefly mention with any of these quality partners that we have is the beauty of what I call the triangle. And what I have found to be very effective over the years when making an introduction to somebody that is a referral, make it, via in writing. And oftentimes what I will do is I will send both people an email, and it'll be, "Dear Bob, meet Vince. Vince, meet Bob. Bob, Vince is a great mortgage lender. Bob is looking to buy a home in the 300 to 350 range. This is how much time he has left. Gentlemen, here are the contact information for the two of you. List the phone numbers and leave it from there, and enable the parties to then connect." And I call that making a triangle. That's a great effective way to make those connections. So strongly encourage everyone to go about it that way. We're on the home stretch here. The last 25 minutes or so, we are going to cover legal and ethical pitfalls. So this is just about 10 snippets, pieces of information, concerns, hot topics that I have seen over the years that are the frequent flyers for areas where we can have legal or ethical pitfalls that I want to keep us out of. So this is kind of an explanation of my department and things to be mindful of. Number one, the first thing that I want to say is that the legal department is not the principal's office. I called someone yesterday morning when I was on my way to court, and he just paused and was quiet and said, "Who is this?" And I said, "Well, because of the fact it's an attorney calling you, you're being quiet, right?" And he kind of laughed, and we got over it. But unfortunately, there's a perception that if you have to deal with an attorney, that for some reason it's a bad thing, and it's not a bad thing. The goal of my department is to either A, help you get out of a jam, or B, prevent you from getting out of a jam, and C, educate us so that we can all go about our active business lives, growing and developing our businesses. So that's my goal with the legal department. First piece of advice that I want to dispense this morning is that when a problem arises, slow down, take a couple deep breaths, and put it in writing to both your manager and to me. Why do I say that? Number one, generally in real estate, the issues aren't life or death. There's only been one instance in the past 3 years where somebody slipped and fell in a parking lot and later died on the operating table because the doctor nicked an artery, where real estate involved that. Okay, so it doesn't hurt to slow it down, number one. Number two is when you start to put it into black and white letters versus words that we just want to rush and say and spend, it starts to take the emotion out of it a little bit. And that's what's critically important with most big issues when it comes to real estate, is taking the emotion out of the situation and just looking at it from a factual set of circumstances. So my general recommendation is put it in an email to the manager and put it in an email to me. That enables me to at least have a 5-minute head start before you make the phone call to me and we start digesting and taking a look at the particular issue. Now, what are the top legal and ethical areas that I call the frequent flyers that are ripe for issues? The first is the seller disclosure form. This is the 2-page document, whether you're in Indiana or in Illinois, that the seller fills out that describes, to the best of their knowledge, the condition of the home. Now, number one, this requires you to fill out to the best of your knowledge. It doesn't mean you get on your hands and knees, crawl through the crawl space to ferret out information that otherwise you normally wouldn't have. Number two is, just because you didn't live in the home doesn't mean you can just run an X through it and say never lived in the home and hand the form in. Frequently where you see that happen is with flippers. Flippers will say, "I never lived in the home," Therefore, I have no duty to disclose anything about it. I'm sorry. Absolutely, that is not the case. There is no item in the state law that says because you never lived in the home, you don't have to disclose anything. No, that's not one of the outs, so to speak. Critical to remember with that seller disclosure form is that A, you fill it out to the best of your knowledge. B, that it's a continuing obligation. So if we fill it out in September, October, a monsoon happens and floods the basement, we're going to close in November, you got to get that sales disclosure form updated. It is a continuing obligation that your client has, and you as the agent need to remind them of that as you approach the closing table. Okay, so make sure that it gets updated, even if it's minor issues. Say that there's a backup in the septic system that happens before closing. You got to update the closing disclosure. Say you have a client that says, well, I only get minor seepage, and the last minor seepage was 3 years ago. Put it in the disclosure. Time and time again, I will get where that happens. And what happens is the folks that buy the home go to make some renovations in the basement. They rip up some of the drywall that's in the basement, and they find the water stains behind the drywall. And they look at the sales disclosure form and they say, well, this is a bunch of malarkey. That said that it never flooded, but this clearly has flooded in the past 3 to 5 years. Even if it's minor seepage, disclose, 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 disclose is my strong recommendation. Other items to take a look at here, especially when you're representing buyers, is if you look on the second page, right-hand side in section 4, there's a section that asks if the work was ever done without a building permit. And frequently you have folks that remodel the house, they complete the basement, they put in that additional room over the garage, and they don't get a building permit for it. Okay, I encourage folks who are helping buyers to take a look at the last time the property was listed, compare those pictures to these new pictures to figure out whether or not these folks did a bunch of work without getting a building permit. You can contact the local municipality and ask, did these folks get a building permit? Why is that important? A month and a half ago, had some folks that bought a building or bought a residential unit, had a beautiful basement, and they're looking at the basement one day and they're like, where's the support running for these cross beams? The guy was kind of an engineer mindset. So the agent went back, took a look at the previous pictures when they used to have the home listed online, come to find out that there were a couple metal poles that used to support the basement in a couple different areas. Well, the prior homeowner took them out so that he could fit his pool table down there. Made sense to him, but from a structural safety vantage point, absolutely didn't. And we were able to accommodate getting a couple $1,000s for this client so that he could properly put these poles back in. I've had it and seen it before where folks bought a property, the agent looked back and said, well, wait a minute, this is now a 5-bedroom, 3-bath, and previously it used to be a 4-bedroom, 2-bath. Oh, they didn't get a building permit for it. Oh, the size of the septic field that's out here was preliminarily for a 4-bedroom, 2-bath. You know what, folks? We're going to set aside $25,000 from this closing, and we are going to verify that this septic system is actually legitimate. $25,000 later, they discovered that A, they never got a building permit, B, the septic system that they had was installed incorrectly, and rather than sloping away from the house, was actually sloping towards the house. So there's a wealth of information that you can find when you take a look at that seller disclosure form and spring off of it. So please communicate to your clients that they need to fill it out competently, thoroughly, and update it. And I recommend when you send that form to your clients to accompany it with a standard email that you've crafted over time. Any questions on the seller disclosure form? Nope. All right, we'll keep going. Next point of information also deals with information, that is the MLS input information. And I get it. It can be tedious. It can be tiresome to go through that document. It may be that the home recently sold, so you've got it already online. You just want to copy and paste. But that information is really critically important. And if it's incorrect, it can lead to potential liability for you as the agent. What do I mean by that? If the listing client tells you, hey, look, I've got hardwood floors throughout everywhere underneath this home, look at them and say, really? Do you? Otherwise, you're going to find yourself in a situation where you advertise that. Thanksgiving rolls around. Thanksgiving Day, your client calls you up and says, I went with my son to Home Depot last night. We were going to spend Thanksgiving afternoon refinishing all of our hardwood floors. Since when is PVC board fine hardwood that you said was underneath all this carpet. You got to be careful with representations. Your clients tell you that we can use the pond that's out back. We've got access to use that pond. So you market it and say beautiful access to beautiful pond, fishing galore, you name it. Well, in actuality, if your clients never owned up to the water's edge, didn't have riparian rights, and the folks find out later, that's a really bad situation. When it comes to your MLS input information, be accurate. Do not make it a guesstimate. Don't copy and paste. Third item, surveys, boundaries, and driveway. I want everyone on this call to get familiar with GIS or Beacon. GIS or Beacon is the website that is utilized. It's a mapping system that's utilized by Newton, LaPorte, Porter County, Stark, Lake County, that you can utilize to see the actual property from a global satellite perspective. And what they have built into the system is the approximate locations of the boundary lines. It's not scientifically exact, but it's approximate. Well, why is that important? Well, what you can do is you can take a quick look at the property from an overview perspective and see whether or not are they sharing a driveway. Is there a possible easement issue that we need to be mindful of here that might not be recorded? Is there a possible encroachment from a neighbor's driveway, from a neighbor's garage, from a neighbor's fence, from a pool, you name it. So get familiar with GIS. Number two, get to understand what your buyer client wants to do with the property. Why is that important? If your buyer communicates to you that, hey, look, we've got a 3-year-old, we've got a 5-year-old, we've got one on the way, and it's our intention to put a fence up around this property, okay? It's not enough to contact the agent on the other side and say, hey, can we put up a fence? And the other agent says over the phone, you bet, Betty, we can totally put up a fence. Your kids are, your clients are going to love it there. Make sure that you and your client do the due diligence to verify that what they want to do with the property can be effectuated. There are multiple areas in St. John and in Valparaiso where there are pipelines that run through high-end developments, and it's underground. And while you can put a pool in some of these areas, you can't put an underground pool in those areas. It has to be an above-ground pool. So that really limits the ability for folks to put up these beautiful gazebos and other accoutrements that they want in their backyard. There's limitations because of these utility easements. So take a look at the surveys, take a look at the title commitments to see whether or not there's any easements, any restrictions that they need to be aware of so that they can effectuate their desire in building around the outside of that home. Last thing that I will say there is when you order a survey for a client, and you should push for them to get a survey if they're going to be doing any work on that property, it is one thing to order the survey. It is another thing to actually take a look at the survey. I can't stress enough when it comes to actually ordering a survey, make sure that it is looked at by the lender, make sure that it's looked at by your client, and make sure that you look at it as well. And it's looked at before the closing table. Same with the title commitment. Fourth item, affirmation of the condition of the home. This is a big area where we can get ourselves in trouble when it comes to serving as a qualified real estate advisor. It is so easy, I know, to walk into a home and a client looks at you as you step outside and you stare up at the roof and they say, well, John, how much life do you think is left on those shingles? And you're like, well, it's a 3 tab and looks like you got a couple peeling over there. I'll bet you probably got 3 to 5 years left. I know I would be faced, I'd want to say those sorts of things. I've got a little bit of background in the construction industry. I would want to help them in that way. You have where folks say, what's that smell? And you say, it's got to be the landfill that's over there. And actually come to find out that the septic field is actually saturated and that's what's causing the smell. So when it comes to affirmations of the conditions of the home, please, please, please leave it to the experts. I've had a couple of cases, had able to resolve them, but folks came in the day before closing and they said, well, there's seems to be some leaching of moisture on the floor. What's going on? You say, well, remember how they had the dehumidifier in there a couple days ago? They took that out. That probably covers it. And the folks say, okay. And they say, well, what about that mildewy smell? The agent said, oh, don't worry about it. Home Depot's got plenty of bleach. You just bleach that sucker down. You're going to be just fine. Days after closing, you've got many Old Faithfuls coming up through the floor, and you got a problem. There are times where you can advise, and there are times where you need to say consult a professional. Those are the times where you should consult a professional. Number 6, writings, calls, or text messages. We started off this morning by talking about how if it can't be handled while you're sitting in a stoplight and a text message on a phone, that it's not that big of an issue. But that can't be the case when it comes to the contract relationships that we are enabling our clients to enter into. I can't stress enough, a text message agreement between 2 agents at 10 o'clock at night agreeing to an extension of a contract is not a contractual amendment that is enforceable in court, okay? 2 agents talking back and forth saying, we'll buy for 400, we'll sell for 400. Susie, we got a deal. Bob, we got a deal, is not an enforceable contract. At the end of the day, you are managing the expectations of your clients. And if you come to those sorts of agreements between agents and you don't put it in writing and you don't put signatures to it, and that crashes and burns, and I see it all too often, guess what's going to happen to the expectations of your client? They're going to be terrible. Your reviews are going to be terrible. They're going to spread bad war stories about you over beers, coffee, you name it, on Friday, Saturday evenings around bonfires with their friends. And that is not what you want. I get it. It is difficult. You may have to be drawn away from your daughter's birthday party. You may have to take the phone call away from your parents' anniversary date night out at a restaurant and handle that phone call. But at the end of the day, if it needs a contract, it needs a contract. Get it in writing. I cannot stress that enough. Number 7, third-party reports. There's a tendency in our industry that our buy or sell clients will say, hey, John, can you call up the septic inspector and order my septic inspection? Sure, I'll get it done. Well, guess whose name gets put on that contract? Yours. And generally, guess who gets asked to throw their credit card on it? Well, yours. We've got nothing in writing between you and your client that says that A, they're going to reimburse you, and B, at the end of the day, that contract isn't with you and Norm's Hauling. It should be with your client and Norm's Hauling. It's okay to act as the broker to get some of these things done, but work with your clients to ensure that it's their name that's on it at the end of the day, that you've effectuated what it is that they want and get them to pay for it, so it's not coming out of your pocket. Number 8, purchase agreement. Read it, and read it. All day long, I'm getting communications on my phone. So all day long, I'm trying to quick bring them up, take a look at it. But when it comes to an actual legal document, I try as much as possible to read it on a large screen or to print it off. It's not because I like to waste paper, okay? But at the end of the day, I know that if I'm looking at a small screen, I am going to miss something. And all too often, I will get it where an agent gets a purchase offer or gets a counter offer back, and they quick skim it on their cell phone, and they miss the $4,000 credit. They miss that they've changed where the title is going to go to, miss something else, and they forward it to the client, say, please sign, and the client signs it blindly, and it's not what they wanted. Again, slow it down, blow it up, take a look to make sure that no one has changed anything on that particular purchase agreement before you sign it. Number 2, when it comes to that purchase agreement and you're making a purchase offer for a client who has told you they are paying cash for a particular property, make sure it's actually cash. Why do I say that? If you are purchasing a property and you are planning on refinancing your existing property or a piece of commercial property that you have, taking that refinance cash to apply towards this purchase, that is not, stress that again, that is not a cash offer. It is contingent upon a bank loan, okay? So if you say that in your purchase agreement and suddenly you lose your job or the property doesn't appraise for as much as you thought it was going to, something bad happens, you don't get that loan, well, guess what? The seller can demand that they keep the escrow funds. You want to scream and shout and say, well, wait a minute, we got denied our loan. I'm sorry, but you said this was a cash offer. You made no contingency that this was contingent upon getting loan approval. So if your client tells you it's cash, make sure it's bullion, Iraqi dinar, you name it, that they have actually saved in the bank. Make sure it's not coming from a HELOC loan or some other refinance. Number 9, be the better agent. you are going to encounter agents that tick you off. You are going to encounter clients that are going to frustrate you. You are going to encounter lenders that are dragging their feet, and you're going to want to disparage them. I get it. Don't do it. At the end of the day, would you rather spend 3 hours with me explaining and crafting an affidavit to the Attorney General saying why you called somebody an a-hole or a jerk or whatever it is? Or would you rather spend that time with your family or working on your business? I prefer you spend it with family and working on your business. I know it's tough sometimes. Take a deep breath. Be the better agent. Don't throw appraisers, title, loan officers, anyone under the bus. Last item that I want to briefly touch on is procuring cause. I remember when I was in the process of buying a house, 2013, my wife and I were bouncing around using differing McColly agents. I had no idea that there was something called procuring cause. And here I was, 3 years of law school, been practicing for 3 years, had never heard of procuring cause. It's completely foreign to anyone outside of the real estate industry. So at the end of the day, used an agent, which was great. They were dynamite. They were awesome. But at the end of the day, I began to think to myself, well, why didn't I end up using this person that I originally started with? And no one had shared with me this concept or this idea of procuring cause. So take the time, especially for your new clients, to educate them about procuring cause and share with them to say, I'm going to invest a lot of time in you. But if at the end of the day, you want to see 1, 2, 3 Bluebird and you can't reach me in 5 minutes and you use somebody else, after you look at it with them, I can't get paid and I can't go back and help you with that transaction. So if I'm not available, this is who you should call immediately. They will work with me. But just educate your folks on procuring cause. If you're working in open house, okay, and 2 people come in and you start talking to the female and she's telling you that they're looking at different properties and you set her up on a search and you work with them. Well, I've seen it twice now where he is actually the money man behind it. She has no money to bring to the table. He actually has a cousin that's an agent, and they end up using the cousin to buy the home after you spent all this time showing them the properties. Okay. So when you're working with people, make sure that if it's a couple, set them both up on the search so that you can show that you got a relationship with the both of them. If you do have a procuring cause claim issue, feel free to contact me, and I am more than happy to exert whatever efforts we need to try and get you paid for that transaction. Any questions from the commercial side? None? All right. Well, I appreciate everyone taking the time this morning and spending it with us in the past couple of days. I certainly hope that it has been helpful. If there are any suggestions, ideas, comments that you have or follow-up questions, feel free to contact myself, Drew, Reese, Heather, Tracy, Monica, everyone that's participated in presenting. And if there are no questions, then we are going to sign out at this point in time. I know it's a beautiful day out there. So everyone enjoy the day, enjoy the weekend, and have a great Thanksgiving holiday next week.